Afternoon, everyone. I think it's afternoon in most of the areas that we might have people attending. And thank you for joining this session on the importance of ESG during uncertain times. My name is Franita Newville. I am speaking to you from Johannesburg today. I am the Performance Director for Analysts and Portfolio Management from Refinitiv. My remit includes Europe, Middle East, and Africa. I'm also a CFA charter holder, and as a result, being based in Johannesburg, I am part of the CFA charter here in South Africa. So I'd like to introduce our speaker for today, Elena Philipova. She is Refinitiv's Global Head of ESG, based in Zurich, Switzerland. So Elena is essentially responsible for the end-to-end management of the ESG business within Refinitiv, also our products and our services. She is also the rapporteur for the benchmarks group of the EU Technical Expert Group on Sustainable Finance, appointed by the European Commission. And previously, Elena worked as head data quality and senior ESG analyst at Asset4, which was the ESG data provider acquired by Thomson Reuters in 2009. And she started her career as a research analyst at Morgan Stanley. Elena also holds an MBA and a BA in finance and international business from Stetson University, Florida. And she's also part of the ESG working group of the CFA Society. So with that, I'll hand over to Elena to take us through her presentation. Just before I do that, I'd just like to reiterate that we'd like to keep the session interactive. We are a smallish group, so if you would like to post any questions, we're happy for you to unmute yourself and ask, or you can post it in the chat and we will be monitoring that and we can answer your question as we go. Thank you very much.
Thank you, Franita, and good afternoon, everyone. Thank you for that introduction, and thanks everyone for taking the time from your busy days to join the session on the importance of ESG at uncertain times. Let me kick off the conversation with a bit of a background and setting the scene for all of you to understand the evolution and the journey of travel to take us where we are today. Sustainable finance and ESG has picked up a lot of momentum globally since 2015, roughly, which was a landmark year that paved the way for a more prosperous and sustainable future for all of us. Two important initiatives happened that year. The first was the 2030 Agenda and the United Nations Sustainable Development Goals, which are 17 universal goals to be achieved by year 2030. And the Paris Agreement on Climate Change, which almost all nations signed and committed to. Companies, governments, investment professionals embraced the UN SDGs quicker than anything we've seen before. So this was a very big phenomenon. And for those of you not aware, the Sustainable Development Goals are 17 goals, targets, and indicators that the United Nations member states are expected to use and frame their agendas, frame their political policies over the next 15 years, at 2015, so until the year 2030. And many participants, market participants, including financial organizations, are using the goals to establish a common framework on monitoring and reporting. And that includes, as mentioned, financial institutions, governments, as well as the corporations themselves. What's important also to note is that financing for sustainable development, for a sustainable future, is available. So it's not a matter of capital. However, the capital is simply not channeled towards this sustainable agenda and commitments at the speed and scale that is required. It's estimated that the financial gap is anywhere between 2.5 to 3 trillion per year, in developing countries. Investing in the sustainable development goals makes also an economic sense, as achieving the SDGs will not only enable us to, frankly speaking, live on the planet, but will also open trillions of new market opportunities and create millions of new jobs. The UN SDGs are really the blueprint to achieving sustainable future and addressing the global social as well as environmental challenges that we face. However, as mentioned, there is a need for a greater sense of urgency to act because the transformation of capital markets is essential for achieving those objectives and achieving both economic as well as social future prosperity. And it's very important for us as individuals, as we make everyday decisions, but it's also very important for us as professionals when making capital allocation decisions and simple investment decisions and choices. The other important factor to mention is that we've also witnessed an evolution in acronyms. And those of you that have been exposed to the sustainability industry, to ESG, you've already experienced a number of different acronyms and ways to describe it, also meaning slightly different things. But ESG and sustainability is certainly not a new field for the financial industry. 40 years ago, even more, we spoke about it with the term of SRI, or socially responsible investing, ethical, religious investing, where bad or sin stocks were excluded. And I would argue that it was easier for investors to perform and apply such strategies because the data requirements were more readily available and straightforward. Then probably about 20 to 25 years ago, the word ESG emerged, and different and more holistic investment strategies also started being developed by market participants. And therefore, there was an increase in the demand for more corporate disclosure across different ESG teams. While in the last few years, we're really talking more about impact, or evaluating the net impact of companies' operations on the environment and the society, as well as the other way around, the impacted environment, as well as social demographic changes and challenges will have on businesses' financial performance. And this two-directional relationship between companies and the environment and society is most recently defined by European regulators as double materiality. And what we're seeing now is investors are really digging deeper than ever before into companies' complete value chain, into their business models and structures. And expectations from companies in terms of monitoring and reporting are really high. Also, technology and the access to large volumes of reporting and information poses a whole new set of challenges, but more importantly, also tremendous opportunities. And it's important to highlight the critical role of stock exchanges in this process to facilitate standardization in disclosure and better corporate transparency, so that the investment industry can, with confidence, use the information that has material impact for their decisions and integrate it across the whole process and the value. And with all of this industry momentum, what of course we've seen is more and more asset managers, asset owners publicly committing to investing in a responsible way. One such illustration can easily be derived from the United Nations principles for responsible investment, where the signatories have reached more than 2,300 as reported last year, from about 100 in 2016. And they hold around 90 trillion US dollars. So it's a very substantial signal of the commitment that we see in the industry for integration of ESG into the investment process. The principles were really developed by investors to serve investors. And in implementing them, signatures contribute to developing a more sustainable global financial system. They have attracted a global signatory base representing the majority of the world's professionally managed investments. And to give you an idea, the principles call out for things like integration of ESG issues into the investment analysis and decision-making process, for active owners to incorporate ESG issues into the ownership policies and practices, to look for appropriate disclosure on ESG issues by entities in which capital is allocated, and so on. So very substantial commitments for full integration into mainstream investment workflows and processes. Jumping on to the next slide, what I thought that it's important to talk about here is the important role that regulation is playing in this transformation of capital markets, as well as the shift in the economy that we're all part of and witnessing, the shift towards low carbon economy. We've seen since 2015, as I mentioned, it was a landmark year for the industry. And since then, over the last 5 years, we've seen regulation around ESG policies doubling. And about 65% of current ESG regulation is coming up from Europe. What the European regulators have put forward is arguably the most comprehensive, as well as most ambitious action plan on financing sustainable growth. It's a strategy which evolves around 3 main objectives and is supported by 10 actions that European regulators believe are essential to implement and execute on the overarching strategy. I think it's very important to highlight the 3 main objectives because as outlined by European regulators, it is believed that sustainable finance and shifting capital markets is the only and one way to ensure future economic prosperity. So the 3 main objectives are reorienting of capital flows towards sustainable investment. The second is mainstreaming sustainability into risk management. And the third is fostering transparency and long-termism. And I think all 3 are quite fundamental, quite important, and introduce a lot of shifts and changes in the way capital markets operate, not only in Europe, but across the world. Now, regulation, of course, is one key driver, but as you know, there are many other drivers, not only for this agenda, but for actions and shifts that we see in the financial industry. Clearly, stock exchanges play a very important role, as mentioned, and I believe that's especially true in the region. Customers and customer demand are shifting, and that creates a lot of new challenges, but importantly, new opportunities for institutional and retail investors. As we see, and currently we're witnessing one of the largest intergenerational wealth transfer to the millennial generation. The way that this generation perceives and sees the impact of investments and the purpose of capital markets is somewhat different from how other generations have seen this. And there are lots of studies written on the topic. For millennial investors, impact, purpose, and profits go hand in hand. And it's very hard for them to comprehend how can you only focus on profits and not searching and seeking positive impacts through the investments and capital allocation decisions. That's another point that I think is important to mention. Again, the critical role and the different drivers that influence the change, but the true momentum which we've seen in the last couple of years is primarily driven through engagement and the intervention that regulators are coming into this space.
Elena, if I could just add to that, I think your points on, the millennial investor is very important, specifically in the Middle Eastern and African markets where, we talk about the demographic dividend in those markets where we have more younger people present in those markets. That could obviously also increase the retail investment, I guess, group just so much more if you do have more millennials or more younger people in your country.
Mm-hmm. Yes, you're absolutely right, Ranita. Jumping on to the next slide, obviously I think it will be not fair to have a conversation these days that doesn't touch on COVID and the pandemic that we're all quite significantly impacted by currently and in the last couple of months, and arguably in the foreseeable future. So how is that impacting sustainable finance? And ESG is a very important question, one that I'm being asked more or less on a daily basis. And what I believe is that sustainability must become the new norm post this pandemic and be at the heart of everyday decisions that we make as citizens, as consumers, and as investment professionals. That's really the only way we can move forward and strive for economic recovery and economic prosperity. Factoring in the impact of investment decisions and consciously allocating capital towards the sustainable future model. This has to be the new norm. And there are two important factors that I think it's worth highlighting. The first is that ESG does translate in resilience, and we've been able to see a lot of evidence that that's true as part of the current pandemic. It has given us an opportunity to test two quite important hypotheses for ESG investing. The first being that it translates to low volatility when the markets are down and we're in a bear market phase, as well as the hypothesis that asset owners search for ESG products and solutions only when they can be afforded in bear markets. So on the first hypothesis, we've seen quite a lot of evidence and research published that ESG indices tend to outperform conventional benchmarks, that ESG companies tend to also perform better now in the first couple of months of this year versus their peer companies and groups. We just also did a study using our Lipper fund database at Refinitiv, analyzing inflows and outflows from different funds. And for the first quarter of 2020, many markets, as we know, felt the first shock of the COVID pandemic. However, inflows into ESG funds were very resistant. And the sector saw a robust level of investment totaling 36 billion only in the first 3 months of this year. And this indeed is lower inflows than previous quarters, but considering the environment and considering the outflows experienced everywhere else, the results are really good. And I think that the main reason for this better performance of ESG companies and portfolios at time of crisis is that sustainable businesses are quality investments. They have corporate culture of compliance, of being transparent about their business practices, strategies, performance, and a high degree of integrity. They have strong corporate governance practices and models in place that serve the needs of all stakeholder groups, not only focusing on maximizing shareholder return. And therefore, they are more resilient and will recover quicker from crisis. And the other point that I think it's important to consider is that we need to fully make the connection and acknowledge that the two topics of climate change and pandemics are very intimately connected and interlinked. There is a broad scientific consensus that the threat of pandemic diseases on humans and economic development is linked to climate change. It's linked to loss in biodiversity and deforestation. And it's quite logical when we think about it, because this expansion of our cities and taking more away from nature, what it simply does is that it brings us much closer and in more frequent contacts with viruses that can spread from animals to people, including the COVID-19 coronavirus, but also dozens of other deadly illnesses. But the good news that at least I think it's important to always focus on the positives in any challenge. And the good news in this challenge is that political leaders, as well as a number of critical international organizations, are already formulating sustainable regulation. They're already putting forward action plans that could help minimize the risk and severity, as well as frequency of future pandemics. Future pandemics will happen. I don't think that's a question of if, but it's a question of what can we do to be more prepared, to be more resilient, and reduce the risks of such pandemics happening frequently. And as the world moves towards recovery from the current pandemic, it's very important to ensure that we finance the right recovery. We finance a just and green recovery so that we can tackle the problem at its roots. Clearly, governments are facing fundamental questions around how to best use the limited funding that's available to ensure socially just recovery, but also finance the green future. However, the private funds are even more critical, and capital allocation decisions must align with the future that we all want to finance. So this is fully in our hands. Next slide, please. So let's maybe go back to a few basics to make sure that everyone on the session today understands ESG, the type of issues that are encompassed, as well as what is the process, what is the workflow to produce this information. So competitive financial results are and will always remain core to all investors. That's at the heart of our industry. However, we do see the shift and the desire to align such returns to positive impact, reflecting either individual customer values, reflecting valuation beliefs that those issues will have significant impact on company value, or any other mandates, preferences, and influences that the different investors are influenced by their stakeholders. So investors do need to choose between, do not need to choose between their money and their values, but rather align them. And last couple of years, what we've seen is a huge increase in the awareness as well as the interest in ESG across both institutional as well as retail investors. as well as more appreciation and more acknowledgement of the notion that good governance translates into better management, not only across ESG issues like carbon footprint or engagement with workforce, but more importantly, it also translates and yields better financial performance. And handling ESG issues well is often a sign of operational excellence in a company, thus translating into higher quality investments. One of my favorite metaphors to explain what ESG is that of an iceberg. What we see at the tip of the iceberg is the financial reporting that sits behind traditional company valuation models. But yet, what's beneath the waterline are all the hidden investment risks and opportunities that are not always fully understood and factored into the investment process. And this is where a lot more attention and a lot more value creation is expected to come from. Investment professionals are really expected to exhibit a higher degree of environmental and social consciousness, while of course continuing to deliver financially positive performance in order to remain competitive and to successfully gain the trust as well as the business of this and the next generation of clients. Now, I did mention a couple of the topics that fall under the ESG term, but it's probably worth calling them out specifically, because I think it's important to understand the multitude of themes that are encompassed in these three very short and simple letters. Under environment, normally what is considered are risks as well as opportunities. Risks tend to be related to the operational footprint of companies, directly or indirectly, their use of resources, waste produced, emissions, pollution on both on air, land, or water. But more importantly, it's also about environmental product innovation and how companies are taking advantage of the opportunities that the environmental challenges and transformations in our economy is creating across industries. And these changes are really transforming every single one industry. And with that transformation, there are lots of opportunities as well. Under the social pillar, normally what's considered is workforce-related matters, whether it's to do with health and safety or diversity and opportunity. Then human rights, and primarily this is through the supply chain of companies. Community engagement and giving back to the communities where businesses operate. And similar to the environmental innovation side, assessing the social responsibility of products and services that companies bring to market. And under governance, issues like board and senior executive composition and compensation, shareholder rights, and specifically minority shareholders and how they're protected in the event of hostile takeover defenses, and an overarching corporate socially responsible strategy and commitment to transparency. Now, there are different types of sources, and diversity of sources also improves quality of information as well as timeliness of information. There are primarily ESG data sourced from companies' sources and corporate reports, whether that's ESG reporting incorporated into the annual reports or integrated reporting or a separate sustainability report. There is usually a wealth of information produced by many companies. And this type of disclosure provides company self-reported statistics and key performance indicators. Then we have third-party information sources like NGO websites, governmental sources, that provide additional insights and a more outside-in view into companies' performance and commitments on different ESG issues. And the third type of data is public information that normally is extracted from media sources or social media, and this provides a more real-time as well outside-in view into companies' performance, to be able to also validate how companies are actually perceived in different communities where they operate, and whether they are indeed true to their commitments and actions. Maybe jumping on to the next slide. What I think makes sense, let me just take a moment to see if there are any questions. Not yet, but I guess I'll encourage again participants to take the time, think through questions. We really want to make this session as informative and valuable to all of you. So if you want me to go in more detail in any one area, do ask a question or steer me in that direction, and I'm happy to do that. What I thought it's very important to do is spend a couple of minutes and talk through some well known and frequently heard statements about ESG investing, which are myths, and let's try to bust a couple of myths. So one is that it costs to be a sustainable investor. And I will certainly put a big fiction button on this slide because this myth is not true. In a couple of years ago, there was a massive study done by, I believe it was Deutsche Bank Asset Management, and in a partnership with a couple of other organizations, to assess all empirical studies done on the performance of ESG information against financial performance. There were more than 2,000 studies in scope of this aggregated analysis. And the conclusions were that majority of research papers proved that ESG and strong ESG performance leads to stronger financial performance as well. What you see here on this slide is an performance chart that we did on a couple of the Refinitiv ESG indices since the beginning of the year versus the parent index, and how they are performing. So you can see that actually we do see steady outperformance versus the parent across all three indices. But that's one example and one illustration. I already talked about what we've seen across funds, and the availability of research on this topic, freely available research on this topic is immense. Another research paper which I saw recently was analyzing ESG leaders from a company perspective versus ESG laggards in the US. And the top 20 ESG leading companies performed 5% better than the market, than the US market in the months of February, March, and April. So there are lots of current studies, but as well as past performance assessment over both short and long-term durations, majority of which do prove outperformance. And I think this message is critically important. Including ESG consideration into the investment process is an obligation that investors have. It is part of their fiduciary duty, as the risk associated with those issues are so evident that asset managers will simply not fulfill their fiduciary duties if they avoid assessing them and fully integrating them into their decision-making processes. On the second myth that I think it's important to talk about is ESG investors invest only in green. I do hear even today some investors associating ESG investing with tree planting and Greenpeace. Not that there is anything wrong with those, but this is one drop into the ESG ocean. And I think it's really important to take this message from this webinar. Because ESG investing includes a variety of strategies, and it is also very individual and personal to each investor. So let me walk you through a couple of the investment strategies to illustrate what I mean. What we spoke already about was the norm-based screening or the negative screening. It's one type of ESG or sustainable investing strategy where certain sectors, certain industries, sin stocks are simply being excluded from the investable universe. And this is arguably one of the oldest sustainable investment strategies. What we saw afterwards emerging is this positive or best-in-class screening, where investors start to look for best-performing ESG assets. And I've been talking about companies, but obviously that's across asset class applicable. So best-in-class assets from an ESG perspective. And when we talk about ESG, again, we talk about environmental, social governance. So it can be any one of these thematic. It's quite okay to have a diversity and inclusion best-in-class screening product. This is certainly falls under the sustainable investment assets and strategies. And you can certainly have some fossil fuel companies there, and that's absolutely fine. What we have then is the ESG integration, and ESG integration, I believe, has now surpassed the negative and exclusionary based screening. This study is published twice a year. It's a biannual study of the industry. So when the 2020 numbers come through, we're going to see. But ESG integration is integrating ESG factors into the investment process as an additional lens, as an additional screen, not something that's done exclusively on the side. Of course, we do see quite a lot of corporate engagement and shareholder activism, where shareholders believe that their biggest opportunity for impact is actually to continue investing in high-intensive sectors, in problematic companies, and engage with the executives and the board to address those sustainable risks that they uncover in the holdings and turn the business around. That's where some investors believe they have the biggest positive impacts on the industry. So as you can understand, there are different investment strategies and different teams that fall under this umbrella. It doesn't mean only one strategy and one asset class or one sector is in scope. To maybe give you a last example, when we think about ESG indices, which are versions of conventional indices, like, for example, S&P 500 or Russell 2000 or FTSE 200. What an ESG version of a conventional index means is simply using ESG information to adjust the asset allocation to each holding, to decide by how much you should overweight or underweight the security. But your diversification and exposure across all sectors remain more or less consistent with the parent index. Okay, let's try to bust one more myth, and that's probably 3 myths is enough for now. Obviously, Refinitiv is a data provider, so it does make sense to talk about data. That's at the heart of our expertise, it's at the heart of our proposition. And what we've seen is an explosion in ESG data. Across all three types of data that I described, whether it's company reporting or third-party data sources or real-time data, the volume of information across ESG issues, performance, risks and opportunities is huge. And traditionally, it's been primarily available across equities as an asset class. But in recent years, we do see quite a lot more information enabling investors to apply their sustainable investment objectives and strategies across multiple asset classes, and that's quite important. But focusing on companies, what we put on this slide is an illustration on the growth in a number of companies that report to CDP. It's the carbon, water, and forestry data. And we see that it has gone up from roughly 300 in 2004 to more than 7,000 last year. And CDP is one reporting framework, one reporting standard, but there are actually quite a lot other ones available as well, focusing across the full spectrum of ESG issues and themes. Probably the most well-known and adopted reporting standard for ESG information is GRI, or the Global Reporting Initiative. Their numbers have experienced a similar growth in terms of companies that use this framework for their ESG reporting at the global scale. And relatively new standards that have emerged in recent years is the TCFD, the Task Force for Climate-Related Disclosure, which specifically defines forward-looking climate-related disclosure that companies should report on. And SASB, the Sustainable Accounting Standards Board out of the US, that looks for financial materiality of ESG information and developing a materiality framework for companies to report on. And all those frameworks see steady growth in number of companies that use the framework to report. But I think that's also one of the challenges, that there are too many frameworks, too many standards. A standard should be one, arguably, that guides companies how to report this information and how to make it most user-friendly for investors. And exactly that problem is something that regulators are acknowledging and addressing, looking to address through intervention. But it's also the role of stock exchanges to bring that clarity to issuers and guide them into the process of what information actually investors need to inform and make better investment decisions. Let me take a moment and just see, I see some questions that have come through. Let me start with the second. So my question is that if we exclude some of the companies in the negative screening process and then choose only the best rated ESG companies, and mostly they would be large size companies, hence from the investment perspective, they might not get the desired return, and they have to be content with low returns. How can you showcase an ESG portfolio to return-oriented customer? So I think at the heart of your question, Kapil, and correct me if I'm wrong, is the notion that there is a company size bias when it comes to ESG data, and the argument that large companies have access to more resources and thus they're able to report more and be more active across multiple ESG issues thus they have better transparency and benefit from better scoring. I would actually argue and say that based on our analysis across our database, you do find a significant number of best performing ESG rated small cap companies as well. And that's why it's really important to acknowledge and be aware of some of the challenges with ESG data. The one that you point out is certainly one that does exist. It actually exists the other way around when you look at controversies, because large cap companies tend to attract more media attention. So some investors argue that as soon as you combine the controversy view and the actual ESG performance based on self-reported data, you tend to balance the two size biases. But acknowledging that there are different investment techniques and strategies to make sure that you are allocated towards the industry and as well as the size of the companies proportionately and evenly. So I think that it is certainly a valid point that you're raising, that there are a number of strategies and ways to counterbalance that effect of greater reporting by large cap companies. Let me pick up the first question. It seems as though the rhetoric around ESG investing has focused on return, with little attention focused on the risk of investing in companies with ESG factors. How is the risk argument developed? Thanks, Steve, for that question. I do think that actually the most broadly used use case of ESG data is for risk management. And we do certainly see that in some of the more mature markets, like the Nordics here in Europe, as well as Australia, potentially, we can argue, where risk management and now more recently stress testing is becoming a critical factor. So my experience, and probably it's mainly shaped by the market where I'm based, is the other way around, where the main use case I see investors using ESG data is for risk management rather than the return and the opportunities in the alpha seeking. Great questions. Let's jump on to the next slide, and I hope a few more questions come in. So let's spend a couple of minutes more talking about the companies and what that means for them and what we see happening with corporations. I do believe that the current pandemic has given us a very unique opportunity to rethink and rebuild a more resilient, more sustainable social model, financial markets, as well as business structures. And in recent years, we've definitely seen that more corporate executives are starting to integrate sustainability inside, not just beside the business. They're continuing and accelerating those shifts. And it's really critical to make sure that these transformations are happening. But what's been more important is that such companies are actually delivering financial outperformance as a result of the structural changes and making that genuine commitment to align profits with purpose. Especially in some of the most difficult sectors where such transformations have been very risky, like in oil and gas. There are a number of companies that have transformed their business models and have continued to grow their financials during that time. So new business leaders are making such fundamental commitments to all stakeholders, and they are more prepared and better resilient during this as well as future social but also environmental crises. Earlier in the year, Refinitiv published a report on governance and sustainability. And as presented there, greater transparency does lead to greater accountability, and thus it leads to better both ESG as well as financial performance. And I do hope and expect that businesses will be pressured by stakeholders to quickly adapt and adopt more sustainable business practices and models, and be transparent about it. And let's face it, any corporate transformation has to start from the top. Sustainable companies have moved away from short-termism in decision-making, like laying off employees during times of crisis, like the one we're in right now, to more long-term thinking and sustainably incorporating those decisions and the long-term vision of companies into everyday decision-making processes. So I think that that's a very important point and very important message to get across, that not only are companies doing the right thing, but they are also being more resilient and delivering better financial results. Next slide, please. I do believe this is a carton I saw just a few days ago, but it is something I've been experiencing throughout my whole career in sustainable finance, which is 15 years. And I want to really leave you with this. Why is that very important? It's very important for each individual investor, each one of us, to know where we're going. Because ESG doesn't mean one thing for everyone. It's not one size fits all. It has very unique implications, as well as it creates very unique risks and opportunities for different investors. Taking into account the environment in which they operate, taking into account the customers that you're serving, taking into account the environment and both regulatory as well as market, as well as social and environmental environment in which investors operate. So think about your investable universe. Think about the assets that you're allocating capital to and the industries that they're part of. What social and environmental topics and issues will have material impact on those investable universes that are relevant to you? Also think about it more strategically. I mean, what is your value proposition to your customers? What are your promises and commitments? What enables you to be the choice for your customers versus other investors? That's what differentiates you. And that's what needs to relate to ESG, and which ESG areas, which ESG teams and topics will have and resonate most effectively with you and your customer base. It's very important to make sure that the direction and the first step of where you're going comes from you, and this will help you to make sure that the right implementation is put in place to meet those objectives, to be part of this transformation, to be part of the solution, and continue delivering on the commitments that you're giving your customers, both in terms of financial performance, but more importantly as well in terms of non-financial impact. Let's see, I see another question has come through. So Lalit is asking, what are the benefits for the companies to follow ESG if liquidity is less of concern? Clearly, in the current crisis, liquidity is a big problem for a number of companies, and they may be tempted to react short term to respond to the liquidity problem in a very short-sighted way. But as mentioned, it's important to ensure that decisions are taken in light of the success and existence of the businesses in the long run, not in light of their success in the short term. And that's part of the problem with capitalism today and the fixation on short-termism, which I hope more and more market participants across the world are acknowledging and realizing that that needs to be balanced with the long-term view. We do see that coming through, that message coming through from regulators. We do see that as well coming through from market participants, and especially asset owners, insurance firms that have by default more long-term view on their investments. I hope that answers your question, because it has different angles that you may look at it. I hope that's the angle you asked it from.
Just, Elena, if I could add one more thing. So something that we've seen is that in the Middle East specifically, demand for ESG reporting by companies is mostly driven by, you know, external investors, if I can put it like that, or maybe global investors who've got global funds, not based in the Middle East. So that's one of the main trends, and for Middle Eastern companies specifically to remain competitive from an investment perspective, it's quite important to obviously for them to disclose their ESG metrics and to come up on ESG screeners, for instance, if those investors who manages these global funds are looking for new opportunities within the Middle East.
Great one. Thank you, Fernita. I don't see any other questions. So I hope that has been valuable and informative session for everyone. Do let us know if you have any follow-up questions, and thank you very much for your time and attention.
Yes, thank you, Elena, for your time. And another thanks goes out to Sevan and the CFA Society Emirates for giving us this platform and this opportunity. Yes, and again, if there are any questions, further questions, you can direct them through to Sevan or the CFA Society Emirates, and they will obviously let Refinitiv have those questions and we can get back to you on those. Thanks, Sevan.